There's nothing like the smell of coffee in the morning, right? Well, get ready because today we're analyzing SBUX company, otherwise known as SBUX. I don't know, get your cup of coffee ready. This pretty much sums it up for me. As you can clearly see, I'm an Office fan. Tap the like if you're also an Office fan. And by the way, I got a quick story to tell you guys. Now, we're digging into SBUX because you guys asked me to in the comments. And so we're doing this today. We're gonna look at the stock and see if this is worth investing in. But I actually stopped drinking SBUX. And if you don't know the story, very quick, $30 a week is what I used to spend on SBUX. Yeah, $30 a week. Do you spend more or less than that? I'd be interested. Comment down below and let me know how much do you spend on SBUX a week? But I was spending $30 a week and I stopped drinking because I want to take those $30 a week and I want to invest it into the stock market. I want a growth portfolio that over time I can look back on and see millions of dollars sitting in my portfolio. Obviously, $30 a week isn't going to get me there, but that, on top of everything else I'm doing, will help me get there, and I want the same for you. So, if SBUX is ruining your budget, get yourself some normal coffee, and let's get going with today's video. I got my 10 smart steps ready to go. If you're not familiar with the 10 smart steps, I'll link the video down below. Let's get going with SBUX. None of this is financial advice. This is for entertainment purposes only. You got to do what works best for you, and you got to do your own research, and you got to make your own decisions. So here we go on today's video. Very first smart step is we got to look at the dividend payout ratio if it pays a dividend. And here we are. You can see before we get to the dividends, we got a price point at the recording of this video at $112.56. Not too bad. Up on the year, 42%. Year to date, up 4%. In 6 months, 6%. Down a little bit this last month. But you can see overall, look at that growth. Even in 10 years at 539% up. Pretty darn good, SBUX. Way to go. Let's look at the dividends. Going to Seeking Alpha and right here on the dividends tab. I'm going to touch on that. And let's see what we got going on here. So right now we can see a payout ratio of 60%. That's not too bad at all. In fact, I will say that is pretty good. Again, we don't want anything closer to 100%. We definitely don't want over 100%. That means they're taking their profits and they're paying it to the shareholders in the form of dividends, basically wiping out all their profit. And if it's over 100%, that means they're tapping into other resources to pay dividends. We don't want that. In this case, smart step number 1 looks pretty good. I'm gonna give SBUX a green light on step 1. Good job. All right, smart step number 2 is the PE ratio. We wanna make sure, does this stock have runway? Is it valued correctly? Is it overvalued, undervalued, at fair market value? That's what we gotta check out. Now, in order to figure this out, all we have to do is go back to the main section of seekingalpha.com on SBUX Corporation. And right here we are. On the far right-hand side, you'll see right here we go. You'll see the PE ratio, and I'll circle this for you right here. And we got a 37.51. Now, I just did Tesla, right? And Tesla was extremely high. It was like well over 100. 37 isn't bad. I like to look for 20 or less. Ideally, 13 to 18 is kind of my jive when it comes down to finding some good growth stocks. Remember, I'm a long-term value growth investor. I'm not a hype stock guy. So for me, I'm looking for things that are going to build up that millionaire portfolio. 37, it's not bad, but it could be better. So I'm going to give them, for smart step number 2, a yellow light. Only because what I want to see is I want to see additional results that will continue to drive that PE in a favorable manner. It's not the worst PE I've seen, but it's not in my desired green zone, so they get a yellow light for smart step number 2. Moving on to smart step number 3, we're going to talk about the earnings per share, and we're going to make sure that it at least meets, if not exceeds, the estimates. So on the main screen of Seeking Alpha, scroll all the way down until you see this right here. Here's our earnings per share. I have it set to annual, and I'm looking at the blue line versus the black line estimates. Now, here's what's really interesting about what we got going on here with SBUX. In 2016, they slightly exceeded their estimate. In 2019, they're kind of right on the money. Same thing with, I'm sorry, that's 2017. 2018, right on the money. 2019, right on the money. And 2020, despite the pandemic, they beat their earning potential. Now you can see it's back up for the estimate of September 2021. Of course, as an investor, if I have SBUX, what I'm looking for is, of course, I want them to at least be right here or be above that. As long as they meet or exceed, I'm a happy guy. And so far, this is looking great. So hats off to SBUX. This smart step number 3 gets a green light when it comes down to earnings per share. Let's keep that going. Remember, I would recommend every quarter If not every year, go back through your stocks and just take a quick peek at them, because remember, you're the owner of these companies when you buy shares of stock. That's what's cool about it. So as an owner of Starbucks, you want to say, do I feel good about the fact that they're doing this with their earnings per share? Do I feel good with their revenue? Do I feel good with their profit? Are they meeting your expectations? And if not, you got to have a talk about that. You got to have a decision. What do you do with your shares of stock? Let's move on to smart step number 4, and that is the news. Now, the news can go a lot of different ways. What I'll say is I was looking at the news, and it looks as though we have a bit of an issue. And that is the demand for coffee is much higher than people estimated. Probably much higher than Starbucks and some of its competitors estimated, because people are coming out of the pandemic. And because people are coming out of the pandemic, they are thirsty for some great morning coffee, and they're probably taking $30 plus per week. And instead of investing it, they're buying Starbucks coffee. So I get it. I can't judge. I've done it myself. But, one thing you got to keep in mind is, because of that news, people are obviously still very much addicted to Starbucks. They're still enjoying the product of Starbucks. And that's what we want as a value investor here. We want to see people continue to enjoy the product. At the same time, I would love to see Starbucks continue to grow their product offerings, to see what else they can do, potentially open more locations if there's some hot spots. Hey, let's talk about delivery. Those are the type of things I want to start seeing in the news in the future, and as well as we go through the next couple of quarters. I want to see, are we seeing some innovation in new coffee types? Are we seeing some new stores open? Are we seeing delivery or some other type of opportunity that they can continue to scale up the business? That's what I'm looking for in the news. But right now, they're going to get a green light on number 4 for the standpoint that we're seeing demand. People are coming out of the pandemic and demand is there. What happens when you have the demand? Theoretically, it's going to increase your revenue. And that's what we want to check. And oh, by the way, that brings us to smart step number 5, which is revenue. We want to look behind the scenes and ensure that their revenue is continuing to grow over the period of time, especially over the last couple of years. So what I'll do is I'll go back to our friend at seekingalpha.com, because it's a free website and I like sharing free resources with you here on the channel. If you like that idea, tap the like button down below. Here we are on revenue, and we're looking at quarterly first. And now quarterly, of course, we got some issues here because of this is like the primary pandemic problem is quarter 3 2020. But let's see, right now it looks like they're starting to level out here. Let's take a look at annual. We want to make sure our annual is looking good over the long period of time for our revenue. So in 2016, we got here to 2017, 2018 went up, 2019, 2020 sucks because of the pandemic, and then it looks like they're estimating that it'll go back up. So things do look pretty good here. Not only is the quarterly starting to rebound, but taking the news that we just talked about with the demand, along with these estimates and what we're seeing over the past here with a nice little line going up on the revenue, I would say smart step number 5 on Starbucks is also going to get a green light. Hey, Starbucks is looking pretty good. By the way, I don't prep these videos in advance. I actually go through this live with you. So as I'm talking through this, it's me looking at the stock. So I don't know if they're going to crash and burn, or if I'm going to run into a mistake, or if something's going to happen, or if Seeking Alpha is going to not respond. I don't know what's going to happen, but I think that's what's kind of cool about it, because I want you to truly see my mindset as I'm going through these type of things, so that you can apply things to your own decision making when you come down to applying these to various different stocks and ETFs and things like that. All right, next up, we got smart step 6. We're looking at the profit margin. Are they profitable? Are they churning a profit? That's like key number 1 in any business. That's what we want. So in order to do that, I got to get my calculator, and what we're taking is the total net income divided by the total revenue. How we can do that is right here on the financials tab of Seeking Alpha. We're going to click on that, and then we're going to hop over here to where it shows us our income statement. So the revenue, and we'll take the latest one. In fact, wait. So we're going to scroll down here, and we're going to look at the net income, and let's go right here. Net income is, I guess what we'll do is we'll take the last, which is December 2020. We'll see how that looks first, and then maybe give them some credit because it is the pandemic and stuff like that. But here we got a 928.3. Okay, so that's in millions, so that's 928 millions of net income. And then their total revenue, let's see, total revenue of, wow, 23,518,000,000. Okay. So let's see what this profit margin is all about. That's only a profit margin of 3.94%. That doesn't look too good. Just for the fun of it, I got to look at 2019 just to make sure, because the pandemic really screwed everything up. So here we got a net income in 2019 of $3.599 billion. And then if I go up here to their 2019 total revenue is 26.508. Okay, so let's do some math on this one here. So we got 3.599 billion divided by 26.508 billion. That looks so much better at a 13.5% profit margin. Anything above 10 gets us excited. So what do you guys want to do with this one? So you got an issue where in 2019 they look profitable. You could go back in time and say, okay, well, let me look at 18 and let me look at 2017, let me look at 16, and look at it that way to see if it's above 10%. So do you give them credit for 2020, or do you just take 2019 and say, forget 2020, forget the past, 2019 looks good, I'll give them a green light? That's up to you. What would you guys decide? Let me know down below in the comments on number 6. I'll tell you what I'm going to decide. I'm going to give them green. The reason I'm giving them green is because I'm giving them credit for 2020. I'm not going to go through the rest of these, but I want to hear your thoughts. Comment down below. Let's go on to smart step number 7 of SBUX. We're going to try to understand what is going on with their assets versus their liabilities. We want assets to be greater than liabilities. In order to do that, you come over here to the balance sheet. You click on balance sheet. You let it load, and we're going to simply look at our assets, and we're going to make sure that they're above that liability number. It's a very simple way to look at it. You don't even have to do any math. So awesome. I don't know about you guys, but I love when I don't have to do math, because I actually kind of secretly hate math. No judging to the math nerds out there. I just hate math. Okay, so December 2020, 29.3, total liabilities 37. Okay, so that's looking pretty bad, guys. Their assets are kind of high. And if we look back over time, we got 19 versus 25, 24 versus 22. So here in 2018, they look good. 14 versus 8. So in 2017, they look good. 14 versus 8. In 2016, they look good. So something's going on, and it's not pandemic related, because from 2019 on, they've taken on more liability than they do assets. So that means if things happen, they don't have enough assets to cover their liabilities. Guess what that means? For smart step number 7, they're going to get a red light. This is our first red light, and for the occasion, as I always got to do, if I can pull this up in time, we got to change back there to red, all right? Because SBUX kind of dropped the ball there with their assets, so that's a red light on smart step number 7. Smart step 8, ownership potential. What kind of common shares outstanding do we have, and are they going down? We want them going down. And scroll down to where it says total common shares outstanding. We'll see it right here. See that? All right, so here's what we're looking at. 2016, we got 1460, 1431, 139, 1184, 1173. That isn't hard math. It's very easy to see that is going down. So for smart step number 8, hold on, gotta pull it up. We're back on green. That's a weird green. There. Let's move on to number 9. Number 9 and number 10 are my most favorite because they mean a lot. And we're looking at our free cash flow. We want to make sure that they have money to power up their ability to use that cash flow for things like dividends, things like share buybacks, things like running their company like a badass. And that's what we want to see when it comes down to free cash flow. All we have to do is hop over to the cash flow statement under financials. In that section, you're going to go down to where it says levered free cash flow. That's the one I like to personally look at because that's after all their accounting is done. So right here it is, levered free cash flow. And we see 25, 2077, 2004, 3685, and then a negative number because of the pandemic. Ooh, we got a little bit of an issue here, guys, because the issue here is that it kind of just bounces around a little bit. We got that 25, we got the 2077, and 2004. The issue I see with it is it's just kind of like all over the place. It has some consistency around 2016 to 2018. But then, okay, it goes up in 2019, and then the pandemic hits. So maybe I'm kind of struggling here. Like, I want to give them a bone, but part of me doesn't. And the reason why, if I erase this really quick, you can see I just don't like the fact that we're going from 25 to 2077 and then sitting there at another 2004. Like, that should recover. Or what's going on in 2016 that made them get that 2.5? You know, that's weird. And then of course you have a successful 2019, and then I guess I can't give them credit for the pandemic. I don't know. So what I'm gonna look for here is I wanna look for the next statement, and I want to keep my eye on their quarterly reports, and I want to look at 2021 to ensure that they're recovering. And because of the demand, will they recover to 2019? We'll have to see, but I at least want to see a 2077 or a 2004 here in 2021. And if I don't, I'm going to be a little bit worried. So with that kind of hesitation, I'm going to give them a yellow light on number 9, because I just want to be cautious of that. So the final smart step is price to free cash flow. This one's gonna be a little bit tricky because if you recall, that last number was a negative number. So that makes it kind of a little bit awkward. So we might need to jump back to 2019 just to do a proper calculation on the price to free cash flow in smart step number 10. Now, I do gotta think for a second, all right, what we want is a lower price, because conversely, a higher price to free cash flow could indicate that they're overvalued. Based on their free cash flow. So maybe what we could do is let's go ahead and take this. Now the calculation, in case you forgot or you're new to the channel, is you take the market cap value of the company and you divide that by the total free cash flow amount. So what we'll do is we'll hop back to summary and we're gonna look at the market cap right here, and it's 132.22 billion. So I'm gonna write that down, 132.22 billion. And then what I wanna do is I wanna hop over to the financials, and I'm gonna hop back to levered free cash flow. Let me go to the levered free cash flow. I'm gonna use this number, this 1979, just because I don't wanna use that negative number, because I wanna give it a proper look here. So here we got 1.979 billion, okay? So we'll get on our calculator, we'll take 132.22 divided by 1.979, and that equals 66.8. Not too bad, it's kind of right in the middle of what I look at. You know, again, lower is better, higher is worse. I think Tesla, which we did earlier, if I recall correctly, was well over 100, it was like 172 or something like that. So I'll say that that's 60, you know, that's pretty good. I will give them a, what should we do here? I'll give them a green light on that, I guess, you know, throwing them a bone on that. But again, there's some things here. Now, I'll tell you what, let's do some calculation. Let's final this up. So we have 1, 2, 3, 4, 5, 6, 7 green lights on Starbucks. SBUX, man, you guys are bringing it in. What I would do as an investor is keep an eye on this. If you already are, make sure you're continuing to check your quarterly reports, check your annual reports to make sure that the company that you own is representing you well and making you the profits that you deserve. Here are some other videos that might help you with your personal finance journey, and we'll see you on the next video.